Security. So a large fraction of people, let's say below the median income, derive most of their income from Social Security. And it also is true that older elderly people, let's say people who are 80 and up, this is their primary source of income. It's a larger source of income for underrepresented minorities, for women. So it really, a 23% across the board cut would really hit some groups extremely hard.
Well, and your work pointed out that there are some groups that get as much as 90% of their income actually off of Social Security. So you take 23% away from that, that is a big haircut.
A huge haircut. And there's no, I think we know how to do this. 40 years ago, I wouldn't say that the approach then is necessarily the optimal one then, but we showed that we can do this together. And I think I'm very optimistic that we can come together and solve this.
Glenn, are you optimistic? Do you have hope? What do you think?
I am, because we have to. You know, in Washington, sometimes math drives the train, not economics, not politics. So I think we have to, and we will.
Where else should we be spending money, Glenn?
Well, again, I think defense is going to be an imperative for the nation. I think investments in training, in research, but all of these things cost money, and so we really have to make trade-offs.
Okay, guys, thanks so much. Really great to have you here. That's Glenn Hubbard of Columbia Business School and Mark Duggan of Stanford. Back to you, Romaine.
All right, thanks there to David Weston. You can catch David every day, of course, as the host of Wall Street Week, which airs 6 p.m. New York time here. Full coverage from the Aspen Economic Forum, conversations with Austin Goolsbee, Raphael Bostic, Cecilia Rouse, as well as Larry Summers. Meanwhile, let's check back in on what's been going on here in the markets. Katie Greifeld, just about an hour ago when we kicked you off to the close here, all the major indices in the U.S. were in the green. As of right now, all the major indices in the red, a sharp downdraft just in the past 30 minutes of trading.
And a lot of that coming from Apple. Looks like shares took another leg lower. They had already been under pressure after last night's earnings report and currently off by 4.7% and continuing to fall. If that holds, Romaine, that will be the worst daily performance since December 2022.
Interesting to see the push and pull between two big heavyweights in that index, the big rally that you're seeing in Amazon, the big sell-off that you're seeing in Apple. At least for right now, we know who's winning that tug of war. The moves that we've seen in the yield space, that still persists, lower by about 13 basis points on your 5-year yield, 11 to 12 basis points on the 10-year. The VIX elevated here on this day, and well, the only real bright spot in the commodity space right now, that belongs to crude oil, up about 1% on the day, heading for what's going to be its 6th straight weekly gain. Rounding out into the final hour of trading.
is Bloomberg Business Week. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news as it happens. Bloomberg Business Week with Carol Masser and Tim Stenivek on Bloomberg Radio.
Happy Friday, everyone. Live from the Bloomberg Interactive Brokers studio, streaming on YouTube and on Bloomberg Originals. It's Friday, August 4th, 2023. I'm Tim Stenivek, along with Madison Mills. Carol Masser is out today. Maddie, how are you?
I am so good on this Friday, unlike the stock market, Tim.
Yeah, well, you know what? I was going to say that it's a reversal of what we saw over the last few days. Stocks rising, bond yields falling, but now stocks have gone negative. Thanks, Apple. Bond yields still falling. This after a mixed jobs report, doing little to change those bets on what the Fed is going to do. You know, Michael McKee is in here. He's international economics and policy correspondent. He's just getting warmed up because he's been in here. Mike, what time did you get in this morning?
6:30, something like that.
That's it?
Yeah, I was a little later.
Summer Friday?
Summer
Half day?
Fridays, yeah.
Is that half
Well, he's
day for
such
you?
a pro. It's not like he needs to prep for how many jobs?
Well, I was in the
report,
bullpen warming up for a while.
There you
Okay,
go.
there we go.
Yeah, of course.
All right,
of
well,
course.
that voice you hear, international economics and policy correspondent Michael McKee, standing by because in just a few minutes we're going to be chatting with him. Everything we need to know about the jobs numbers, and then we'll get market reaction too from Jess Metton.
Yeah, which we're so excited about. We've also got kind of a triple header of CEOs today, Tim. We've got the CEO of Informatica, the CEO of the Bitcoin application company Trust Machines, and we've got the CEO of the United States Hispanic Business Council to talk about those job numbers from today.
So a couple other big stories that we're talking about. John Tozzi's got a great one out about how employers are starting to lose trust in their health insurers. We're going to check in with him during the 5 o'clock hour. And Maddie, we are going to a little place called Aspen.
Oh, yeah.
We're going to check in with David Weston. He's been at the 2023 meeting of the Aspen Economic Strategy Group.
My intro for this is so boring.
good.
Did you see it? I was
so
like,
good.
David Weston gets to go to Aspen. So
Davos,
he's got a great job.
Aspen. He does have a great job. He's been speaking to some really incredible guests. Glenn Hubbard was just on there from Columbia Business School, and he
You
caught
know
up with
him
Raphael
from your
Bostic.
time.
He was dean when I was at business school. That's right, and we've had him on the program here too, as well. We got a great program today. Let's check on the markets. The Dow is down 0.3% right now. The S&P 500 down 0.3% as well. Well, the Nasdaq down a little more than 0.1%. Apple really dragging down the S&P 500 today. On the flip side of that, though, we got Amazon after those results yesterday came in better than expected. Amazon surging among the best performers today, and that is helping to bring the market. Well, it was higher earlier, now a little bit lower. All of this to come. First up, though, let's bring in our TV colleagues as Bloomberg's countdown to the close starts right now.
Countdown to the close. Bloomberg's comprehensive cross-platform coverage ahead of the U.S. market close starts right now.
This is the countdown to the close. Romaine Bostic here alongside Katie Greifeld. We're joined right now by our colleagues, Tim Stenivek and Madison Mills. Welcome to our audiences across Bloomberg Television, Radio, Originals, and those folks streaming on YouTube. A down day here for the markets, a down week as well.
Yeah, is this first down week or most down week since March, Romaine? What is it, first down week since March? Most down week?
Well, no, it depends on what indice you're looking at
S&P
here.
500.
But we talk about this idea here of how sentiment had started to improve. And of course, now you get the little bit of a flip-flop here, not only just on the week, but frankly, on the day. This was supposed to be an update, Tim.
Yeah, I was
What
surprised. I think declines in Apple happened. They got a little bigger. Apple was down just 3%. It moves down 4%. Then the entire S&P 500 goes negative.
That hurts.
I guess what I'm more interested in is the fact that we're all at work today. We decided to come in.
What a segue.
Yeah.
We decided to come in. It turns out another study is out talking about productivity in the workplace, working from home versus those folks who go into the office. Economists at MIT and UCLA, they found that workers randomly assigned to work from home full-time are 18% less productive than those who are in the office. Now, there are a lot of caveats to this.
Who sponsored this study?
Big office.
Big office. Yeah, exactly.
Well, and overall, as you
That
guys
study
can
brought to you by
see,
Court Furniture Rental.
oh, there you go. There you go. But as you guys can see right now, overall productivity is up. And when you look at this study, it is, to your point, I know we're joking around, but it is about new hires specifically. And I don't know about you guys, but I feel like I'm not exactly my most productive my first couple months in a new job.
No.
You're kind of getting your feet wet. You know what I mean, Katie? So
Yeah, that's not fair at all. But
Yeah.
in any case, also, I don't know. I feel like I'm less productive at the office because my friends are here. I spend all day.
You just hang out? You just getting coffee all the time?
I'm up on 6, I'm getting coffee. It's ridiculous.
Well, I mean, it's interesting, yeah, too. I mean, look, there'll be a lot of people parsing whether we're more productive at home or in the office here, but I thought those productivity numbers that we did get, what was it, yesterday, those quarterly numbers, and kind of, remember, I mean, there hasn't been a productivity story in this country now for quite a few years here, so to see that sort of quarterly uptick for, what was it, 4th or 5th straight quarter, certainly something to be encouraged by.
Well, sticking kind of with the labor market, a story that caught my eye is that we know for a lot of the tech giants, we went through that layoff cycle. A few months ago, it was all we were talking about. But what's interesting now, after we saw those layoffs earlier in the year, now the tech giants are cutting back on their marketing budgets. And you can see that if you take a look at some of the earnings reports of large advertising companies that reported a sharp cutback in spending from US tech and telecom companies. We heard from WPP, so this is a UK-based advertising group. It cut its revenue guidance for the full year, and it was citing lower sales in the US, specifically from their tech clients.
Yeah, well, and I like this too. I mean, this was kind of the old school indicator, right? Was like whenever you were sort of looking for that economic cyclicality to the downside, you just look at the advertising space. In the old days, of course, it was all newspapers and magazines, but it's the tech ad space right now, and if that weakness is there, what does that tell you?
Yeah, and then you see a lot more of this weakness even when you look at earnings for Pinterest and Snap, really relying on those ad sales numbers. And it was very clear in those earnings reports that we've gotten that ad sales are down so far this year, Tim. So it makes you wonder whether these CMO budgets are just getting completely squeezed across the US and what that's going to kind of look like moving forward.
Listen, we've been talking about Apple all day since they reported results yesterday, but you have to ask if they need to actually spend more money on marketing to actually get more people to buy iPhones, because that was pretty disappointing to a lot of analysts, and one of the reasons why we're seeing shares fall today. Guys, thanks for coming in today.
Yeah.
Don't go anywhere, because we're going to be back in a little under an hour, live on TV, radio, and YouTube, also on Bloomberg Originals, 4 p.m. Beyond the Bell, our coverage when we take
It was a little bit mixed today.
It was. I do want to say one thing.
Yeah.
Okay.
Say it.
That I didn't get to say during the simulcast.
What?
So the story that we talked about earlier, about how the decline in productivity when people were at home, there was a comment in there from somebody who studies this stuff and said, you know what? It might actually even out if you're saving money as a company on real estate by not having an office, which I thought was like the most 2023 thing anyone could ever say.
Yeah.
Okay, it's okay for your employees to be less productive because you're spending less money on
Yeah.
employee.
That reminds me of the Shopify meeting thing. Do you
Yeah.
remember that? It
Yeah.
happened while you were out, but they have a charge next to each meeting to indicate how much money the company is losing.
You know, we had that for a company that I worked at that no longer exists. So
maybe it's a negative indicator.
Could be.
Maybe it's a negative indicator.
Sorry, Maddie, I cut you off when you were talking
No,
about
it's
these
because
jobs numbers.
No. It's because you have such incredible insights to share. Having said that, I want to just jump into our guests here because we got to make sense of the market moves and the eco data we've got so far today. We've got Michael McKee, Bloomberg International Economics and Policy Correspondent, and Jess Menton in the room, Bloomberg Deputy Team Leader for U.S. Equities. Mike, let's start with you because cracks in the jobs market, but wages are up. Which does the Fed care about more?
I think I wouldn't put it as cracks in the job market. I'd put it as sort of like wearing away, a little erosion. Fed's been trying to slow growth, and growth has been slowing a little bit. So we don't know whether this, again, I think I said this last month, that whether this is companies can't find workers or they're just not hiring as many people, because we still have a lot of open jobs according to the JOLTS report. But the indication might be that they're just not hiring as many people because we saw average hours worked drop a little bit. Which gets us to the controversy over the wages thing, and some people saying that because it didn't go down 0.4 for the month and 4.4% for the year, same as last month, that's an inflation danger. Larry Summers telling David Weston that. But others point out that because hours worked went down, that's fewer hours at which those people are being paid that 4.4%. So it kind of evens out. And maybe it's not as bad as we think. And then, since this is the David Weston fan club show,
Yeah, of course.
we should note that he also interviewed Austin Goolsbee from the Chicago Fed and Raphael Bostic from the Atlanta Fed today, both of whom said the same thing, which is that wages follow inflation, not the other way around.
Can you explain
so
that?
wait, hold on.
Go,
What's
go.
the deal with the Fed members just going to the mountains in the summer? So you got Aspen happening right now. In just a few weeks, there's Jackson Hole, where I'm sure you'll be there, right?
Yeah,
You're always
I'll be there.
You got the cowboy hat. You got the cowboy boots. What's the deal? Sounds like a great gig.
It is a great gig. I've been to the Aspen one too, and it's lovely out there. You can't beat it. And you know, it's only fair that they do that because the ECB goes to Sintra up in the mountains of Portugal. No, it's the Aspen has had the Aspen Economic Symposium for years. Doesn't really have anything to do with the Fed, but they invite Fed people. The year I was there, Mark Zuckerberg was the big draw. For some reason, I don't know why people want to talk to him. But then the Jackson Hole Fed thing is all about Paul Volcker and the fact that he liked fly fishing. They wanted to get this event established, and they figured if they got the Fed chairman to come, then other people who were important would come. And somebody said to them, well, you know, he's a big fly fisherman. Is there anywhere in your district where there's great fly fishing? And somebody pointed out Jackson Hole. And they moved it there. They held it there. He came, and the rest is history.
Jay Powell doesn't bring his fly rod?
I have not fished with Jay, but there are a number of others on the Fed who do bring their fly rods.
Okay, I like it. Okay, we digress. I'm sorry. There's also a market reaction to this, which is why we're so pleased to have with us Jess Benton. She's Bloomberg Deputy Team Leader for U.S. Equities. I want to talk equities because we saw a little bit of a turnaround in the S&P 500 just within the last hour, Jess. Not related to the jobs report at all.
No.
But because you're in here, I'm still going to tap into this knowledge.
Right.
Is this all just Apple?
It is. When you have a company that's weighting in the S&P 500 is more than 7%, it's on its pace for its worst day of the year. So the stock is down around 4.5% today. But on the flip side of that, you have Amazon on pace for its best day of the year, but it has a 3% weighting. That still is the third largest company, though, in the index. So even when you are the third biggest company in the S&P 500 and you're up close to 10%, Apple still has a much larger weighting. And so a little bit more than a 4% move there can clearly turn the index like that.
I was confused, though, because Apple already lost their $3 trillion market cap today. They were already down. What was the catalyst behind this deeper sell-off this afternoon?
Part of it could also be this stock was up around 50% year to date heading into this earnings report after the bell yesterday, as was Amazon was up around 50% as well this year. And so some of it could also be just investors who are kind of pulling back and selling some of the winners in their portfolios, waiting, if you're talking about from a valuation perspective. We've talked so much about these sort of magnificent seven names. We still have NVIDIA, though, that doesn't report until the 23rd later this month, which is right before Jackson Hole. Starting date on the 24th.
Mike already might be gone by then.
Right, and about 80% of the market cap for the S&P 500 has reported earnings. So I know a lot of people want to talk about, hey, we're close to the end, but you still have a swath of retailers that haven't reported yet. So you have actually Walmart on the 17th. You still need to hear from Macy's, Nordstrom, Kohl's, all of these other department stores that I know Maddie likes to look at as far as when it comes to the reading for the consumer. So far, though, if you talk to, say, Gina Martin-Adams and her team at Bloomberg Intelligence and you crunch the data there, they think the worst of the pain is actually past because we've talked so much about an earnings recession. But when you take out energy, that actually was the leader last year, not only in the stock market, but for the growth outlook because of what was happening with inflation, higher commodity prices. The flip side of that would be true this year because they are the ones with the weaker outlook. So it's sort of casting a shadow over some strength we're actually seeing in technology, industrials, and discretionary, which are more cyclically oriented corners of the market. So if you look at the earnings revision momentum from Bloomberg Intelligence, actually analysts on Wall Street are marking up those EPS projections over the next year at the fastest rate they have in a few months now. So that actually would bode well. But obviously that hinges on the trajectory of the economy. And it's interesting because not only did early earlier this week, the economics teams at Bank of America dropped their recession call, but just today, the economists at JP Morgan also dropped theirs. So now, not only are we seeing strategists begin to capitulate a little bit, you're also seeing that on the macro side too at some firms. Even though there are some house divided a little bit at some of these Wall Street banks, where not all of them agree under one roof.
Which I always love when that is happening. I'm curious, Mike, if you can talk to me about the consumer that Jess was just mentioning, because in that B of A note, not only did they change their recession call, they also changed their anticipation of the Fed's floor, the higher for longer conversation that we've been having. I'm curious how much the higher for longer approach could stand to hurt the consumer and potentially push us into a recession.
Well, it gets pretty complicated because what you have is the Fed trying to bring demand down. So the question is not whether consumers continue to spend. That's okay. It's that they don't continue to increase spending on a major basis and then have to borrow or, throw the economy out of whack to do that.
What do I look at for that? To see consumer spending increasing? Is it
with the retail sales report and then the PCE spending report, because that incorporates the services spending as well. But if we got a soft landing like these houses are talking about now, then consumers would not stop spending. And from what we have seen, there's been a sort of a change in the mixture of spending, and we've gone back to sort of a level of spending that we had in 2019, so pre-pandemic. So things are looking okay there. There's still a group of people, including the terrifically talented economists at Bloomberg Economics, who think that we will have a recession because consumers will pull back and stop spending because they're going to run out of money. So we're going to have to see. But if that starts to happen, if we get a recession, the Fed cuts interest rates, and you end up with less of a problem for consumers. And if inflation goes down, even if we don't have a recession, the Fed cuts interest rates because they don't want real rates to go up. As inflation falls, real rates go up and financial conditions get tighter, a stealth tightening as they call it. So the Fed would be looking, they're all talking about maybe the middle of next year, looking to begin lowering interest rates. So it's not as easy as saying we're just going to see rates go up. And even if they stay up, it's going to have an effect.
Jess, we're going to give you the last word, 20 seconds of what you're looking forward to next week. You're not going on vacation, are you?
I'm not. I won't be here.
Okay.
I know that Mike is also looking at this next week. CPI is coming out. So next Thursday it's coming out, as well as PPI the following day. The reason I watch the two is the spread between the both and what that means for corporate margins.
It's good thing. I was just going to say, Jess and I are planning a party for CPI.
Of course.
All right, well, you guys better get out of here soon and get ready, rest for the weekend.
Funny party hats.
I'm looking forward to that. Big thank you to Jess Venn, Bloomberg Deputy Team Leader for U.S. Equities, and of course, Michael McKee, Bloomberg International Economics and Policy Correspondent. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 3:21 on Wall Street. We do check markets all day long at Bloomberg. We've got the Dow, the S&P, NASDAQ 100 index, and yes, the Russell 2000, all in the red right now. 39 minutes to go ahead of the closing bell. 10-year yield 4.04% with a 2-year 4.78%. The stock market erased gains as Apple dipped below the $3 trillion mark, and some other mega caps like Tesla and Meta Platforms also push lower. Tesla shares, they're down 2.1% right now. Meta is tumbling by about 0.4%. Bond yields fell as a mixed jobs report did little to alter bets on the outlook for Fed policy. 10-year yield again 4.04% with that 2-year 4.78%. Spot gold up $7 the ounce to $19.41, a gain there of 0.4%. West Texas Intermediate crude up 1.3%, $82.61 a barrel. Equity markets lower across the board. S&P right now down 20 points, down 0.5%. The Dow down 142, down 0.4%. NASDAQ down 30, a drop there of 0.2%. Jobs Friday. Austin Goolsbee is the president and CEO of the Federal Reserve Bank of Chicago. And on Bloomberg Markets this morning, he told us workers are returning.
It's been the surprise of the year, of the 6 months, that all of the people that folks thought were gone from the labor force, never to return, a lot of them are coming back. You know, when the job market is as strong as that, you've seen labor force participation rise back to levels that we hadn't seen for several years at least. So that's been great. I mean, that's the strongest part of the economy.
And you can hear more of that conversation on the Bloomberg Markets podcast. You can download it wherever you get your podcasts. Briefly, Icon Enterprises shares plunging 24%. After earnings, Apple down 4.4%. After earnings, Amazon up 9%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right. Thank you so much, Charlie. That jobs report, we've been talking about it all day, Tim, because, you know, it had a little something for everyone, right? You've got the job growth remaining steady, non-farm payrolls climbing slightly less than forecast, potentially a victory for the Fed there. But the bad news for them, wages still going up.
Hey, that's good news for us.
That's good.
As workers,
great
right?
news for us, Tim, and hopefully for our listeners here. So joining us to discuss and kind of suss out the top line takeaway here for us is Julia Pollack. She's the chief economist of ZipRecruiter. And Julia, it's great to have you on again here. I'm trying to figure out how to read the good and the bad news of this report. So just in terms of putting it into historical context for me, would you say this is the first report we've gotten that puts us back to pre-pandemic levels and vibes?
Yeah, this is pretty much in line with the pre-pandemic rate of job growth. But I would say on wage growth, I don't think this is all worrying news for the Fed and on the inflation front. Because the work week has actually become shorter over the past year, average weekly earnings have only risen 3.5%, even though average hourly earnings have risen 4.4%. So that 3.5% weekly wage growth is completely consistent with the Fed's 2% inflation. And then the data we got earlier this week on productivity also suggests that high wage growth is sustainable because productivity is rising.
Julia, we love talking to you because on ZipRecruiter, you have a great insight into the types of jobs people are looking for and the types of jobs people are applying for. Michael McKee, our international economics and policy correspondent, was in here a little earlier, and he was saying there's a little bit of debate about, okay, are people just not hiring at the same rate that they were hiring at earlier, or are people just not wanting to work at the same rate that they were wanting to work at earlier? What are you seeing on your platform?
Well, job seekers have come back, and we've seen job seeker engagement on jobs rising 69% over the year. So it's not that workers are not available and not ready to work, although many employers say that while they can find entry-level workers quite easily, they're struggling to find people with specific credentials and qualifications. And they're also struggling to find people, with 5 to 10 or 10 to 15 years of experience. So quality is still a tricky issue for employers.
Why is that?
It's hard to know. One issue is that many older workers left during the pandemic and they have not returned, and they've taken a huge amount of skill and knowledge with them. Many industries are also finding that the talent pipeline has sort of run dry. Fewer workers are majoring, say, in accounting. It's just not such an exciting, appealing career anymore for young people who would rather be in tech or in social media or vlogging or goodness knows what.
Influencers.
So, exactly, they'd rather be influencers.
Right. Well,
they'd rather be celebrities.
Yeah, and it's so interesting. I want to pick up on that because we were talking with Mike McKee, as Tim said, about how the biggest job loss category in this print was in management. We're starting to see, at least in the data, that companies are kind of hoarding that lower skilled, cheaper, more affordable labor and getting rid of their higher level employees that cost them a little bit more. So help me understand where you're seeing that. You're seeing less people with more skills out there available to be employed?
Yeah, so it's a challenging situation for employers. We're also seeing employers move away from their sort of excessive reliance during the pandemic on contract workers and temporary help agency staff. And they're shifting from those temporary recruitment strategies like signing bonuses to more long-term workforce management policies. We're seeing a large increase in the share of job postings on ZipRecruiter that offer health insurance and that offer retirement plans. And that's a good sign to me. It suggests that employers are actually hiring in-house staff and trying to find ways not just to get them in the door, but to keep them there and keep them happy.
What about getting employees to the office? We've spoken to you several times over the past few years, Julia, about listings that show hybrid work or remote work. There's been a lot of discussion, at least here in New York City, about getting workers back to the office, and also from companies such as Amazon and more tech companies like Apple as well. What are you seeing on the platform?
So remote listings have mostly plateaued in most industries, although there are several industries where they have declined recently, like in customer service. There are some where they continue to rise, like in consulting and financial services. So it really is a mix. And companies are carefully weighing the trade-offs, the cost savings, the recruitment benefits, the retention benefits. Some studies show a decline in attrition of 35%, which dramatically lowers your turnover costs. So there are huge benefits from remote work, but one needs to do it right so that one doesn't lose mentorship and collaboration.
Well, we know that remote work is one of the things contributing to that attrition and people switching jobs. I'm curious about pay when it comes to switching jobs, because we know from the ADP report earlier this week that you do stand to gain on the wage front when you switch jobs. You're getting about a 10% increase in wages as opposed to 6% when you stay in the job that you currently have. What are you seeing on your platform when it comes to the ability for workers to get higher salaries if they are kind of job hopping around?
So the majority of job switchers are still getting pretty substantial wage increases, but the share who are increasing their wages when they switch is actually going down. Part of that is a matter of choice. So workers are prepared to give up pay in order to get remote work. They're prepared to give up about 8 to 10% of their pay because remote work saves you time and money.
That's a lot to give up for remote work.
Yeah, but think about what it... Well, go ahead, Julia.
Yeah, but if you gained 70 minutes a day that you would have spent commuting, and if you save $5,000 a year on transportation costs, it can really make up for it. And then if you
70
have children,
minutes a day?
Yeah, and if you have children and you spend
Exactly.
a lot of time in the car and you have to pay for childcare, for that during that commute, and you sit there in the car feeling like, how on earth am I doing this, wasting my life when I could be with my kids and I'm paying for childcare on top of it? Those kinds of savings are not just financial savings, but they're psychic cost savings as well.
I feel like I'm getting triggered here by you saying those things. But it's true. I mean, I spend about 45 minutes round trip commuting from my apartment.
Wait, but Tim, say the thing you said earlier about productivity and the return to work.
This is interesting, Julia. We have a story out on the Bloomberg about a study that economists at MIT and UCLA did that shows that people are less productive at home by about 18%. Right. These are new hires, and they did experiment new hires in India. But they did talk to somebody for the article who said, you know what, these people might be less productive if they're at home, but the company may save money on real estate. So if the company's not spending the money on real estate, it's okay to have these lower productivity workers.
So the real estate savings are actually a small piece of the pie because in most companies. In most companies today in the United States, in knowledge industries, your biggest cost is your people. And when you can recruit people across the country from lower cost places, you can get talent much more cheaply. And then if they're prepared to do the job and stay there for longer without big wage increases because they're so happy and they enjoy the work-life balance that they've got, you can save and have reduced wage growth pressure as well. So there are lots of reasons to sort of balance the productivity and cost savings benefits. Then the evidence on productivity is mixed. There are plenty of studies that show productivity gains, like studies of customer support agents that found that they gained an additional day a week of productivity because they made many more calls during times when they would otherwise have been commuting.
Julia, 10 seconds here. What type of employee is having the easiest time finding work right now?
Healthcare. The industry is on a tear. It's gained enormous numbers of jobs for 18 straight months now.
Well, we had a great story on healthcare coming up a little later today with John Tozzi during the 5 o'clock hour. It's about the changing relationships that employers have with the health insurance that they're paying so much money to insure their workers. Julia Pollack, really appreciate you taking the time. Chief Economist at ZipRecruiter, joining us on the July Jobs Report and all things employment. Let's get a check on the latest world and national news with Nancy Lyons in the Bloomberg 99.1 newsroom in Washington, D.C. Hey, Nance.
Thanks, Tim. There is a new development in the investigation of New York's Gilgo Beach murders. Suffolk County DA Raymond Tierney says they finally identified a woman they'd been calling Fire Island Jane Doe.
We are here to announce that as part of the Gilgo Task Force re-examination of all the evidence in the case, we were able to identify Fire Island Jane Doe as Karen Vergata, who was 34 years old at the time of her disappearance.
Tierney says at this time there are no charges, and he would not discuss whether they've identified any suspects. Karen Vergata's partial remains were found in 1996 on Fire Island, and bone fragments were later found on Gilgo Beach in 2011. New Jersey's Lieutenant Governor Sheila Oliver, who died this week of an undisclosed medical condition, will be honored with a 3-day state funeral. We get details from Bloomberg's Michael Barr.
Democratic Governor Phil Murphy said that Oliver would lie in state in the Capitol Rotunda August 10th, followed by a similar honor in her home, Essex County's historic courthouse, on August 11th. A funeral is set for August 12th in Newark's Basilica of the Sacred Heart. She died serving as acting governor while Murphy was vacationing in Italy. Murphy cut his trip short and returned to New Jersey. As of today, flags at state buildings are flying at half-staff for Oliver and will remain that way for a month. In New York, Michael Barr, Bloomberg Radio.
Former New Jersey governor and current Republican presidential candidate Chris Christie made an unannounced visit to Kyiv today and met with Ukrainian President Volodymyr Zelensky. Christie said he supports more U.S. aid going to Ukraine, and he says it's important the U.S. is on the right side. One of Christie's rivals in the GOP field, former Vice President Mike Pence, made a trip to Ukraine in June. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Nancy Lyons.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 3:40 on Wall Street. We do check markets all day long. Here at Bloomberg, we've got the Dow, the S&P, NASDAQ 100 index, Russell 2000, all in the red, giving up earlier gains. A down Friday, a jobs Friday. Let's head right over to the first word breaking news desk for today's afternoon call. Here he is, Bill Maloney.
And good afternoon, Charlie. That's right. A reversal for stocks as Apple adds to its losses. Dow is currently down 169 points, was up 290. S&P's dropped 24, and NASDAQ is lower by 45. The U.S. 10-year yield sinks to 4.05%. Gold is up 7, oil with a bid, and Bitcoin is lower by 1%. Among the main 11 S&P sectors, leaders were energy and consumer discretionary. Utilities, tech, and real estate were under pressure. And leaders to the upside in the Dow, Amgen and Intel, while Apple fell 4.4% and led to the downside. Also note that Apple fell below the 50-day moving average for its first time since January. After earnings, internet security name Fortinet fell 25%. That's the most ever. And wrapping things up, Icon Enterprises plunged as much as 37% after cutting its payout in half. Live from the first breaking news desk, I'm Bill Maloney. Charlie?
Okay, we thank you very much, Bill Maloney. And here, live breaking news over your Bloomberg. Type Squawk, SQUA, on your Bloomberg terminal. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
Well, thank you so much for that update, Charlie Pellet and Bill Maloney. We just heard all the details from them, but worth repeating. Stocks now lower after spending much of the day higher. That reversal thanks to Apple moving lower, adding to its losses. Apple down right now about 4.6%. But let's talk big picture here, get an idea for what's going on, not just today, but with the macroeconomic picture, and especially after that jobs report, how things are looking for the Fed's September meeting. Very pleased to have with us Leo Kelly, founder and CEO at Verdance Capital Advisors, joining us this afternoon on Zoom from Hunt Valley, Maryland. Leo, good to have you back with us. How are you?
I am well, thanks. It's good to be back. Always enjoy the Bloomberg radio show.
Oh, well, we love it when you join us. So happy Friday. And yeah, thanks again for coming on the program. What are you looking at on a day where we get a jobs report that kind of has a little bit for everyone, but we're still seeing some weakness in the equity market as a result of some of those mega cap tech companies lagging?
Yeah, I think what we're starting to see is that as the market reaches higher and higher levels, it continues to be priced for perfection, and continues that razor thin line of perfection is just getting tighter and tighter. And so the market is going to start to, as it discerns through various different pieces of information, does this mean the Fed's going to keep raising? Does this mean we're out of the woods, recession, non-recession? I think we're in one of those periods where we're so optimistic right now that the market just wants everything to be good news. And so just slight concerns are really going to have a negative impact on the market.
What's the slight concern of today? Is it Apple's iPhone miss?
Yeah, I think it's Apple's iPhone miss. I also, again, I think we were expecting Apple to just blow the cover off the ball.
Because it does that every time.
Everything is priced. But that's where the market's priced, whether it's Apple or it's the market as a whole. Remember, this week we've gone down. Earlier in the week, we saw a great ADP jobs number. But just before that, we had the ISM numbers come out. And the forward-looking jobs number for ISM was horrible. It was one of the worst readings since 2020. I think this is indicative of the moment we're in. There's a lot of capital still sloshing around the system. When M2 money supply went up 40% in 2 years, and we just haven't gotten the money out of the system. So you're getting these mixed readings where sometimes the economy looks strong and we're ready to take off. And then the next report, you say, oh my goodness, we might be in a recession by the fourth quarter. So the market, I think, is going to be volatile here. And remember, seasonally, we're heading into a rough spot.
Ed Yardini said today that we are not in a rolling recession. We're in a rolling recovery. Would you agree with that?
Well, I think we're in an earnings recession, and yet stocks have gone higher. Remember, most of the gains here have been PE expansion, not earnings expansion. I do think when we look, the Fed is going to get what it wants. Inflation is starting to slow down. But if they take their foot off the accelerator even a little bit, inflation is going to come roaring back. And what that tells me is that this hope that the Fed is going to stop and we're going to get a thrust in the economy, I think you have to be very, very cautious with that.
Why are you thinking that the Fed should not lay their foot off the gas here, given that we are still seeing such strong consumer spending, we're still seeing strong wages, strong jobs data?
Well, we're also seeing some weakening. So as I said, ISM, the jobs information was actually not too good, and that's forward looking. We're seeing credit card debt expand dramatically. We're seeing delinquency rates go up. We're seeing the banks starting to take loan loss reserves, and we still haven't seen the impact of what we're seeing consistently in the surveys of tightening credit conditions at banks and commercial real estate. So right now, just to give you an idea, we're neutral in our equity position. We're neutral. And that speaks to where we are. I can point to 10 things that would make you concerned about the economy, and you could point back with 10 that make it look pretty good. And what that speaks to is exactly what we've been talking about on this program for a few years. And that is when you flood the system with trillions of dollars artificially, you create an economic anomaly, the greatest economic anomaly in history. And the result of that is you're going to get these very confusing periods where as we unwind the anomaly, the information's not going to make a lot of sense. We think this is a more cautionary environment. And by the way, you're getting 5% on your short treasury.
Yeah,
so
that's
it's not
true.
like you're not getting anything. Yeah, it's just now's not the time to go chase tech, go chase the high price stuff and overweight your portfolio. It doesn't make sense after a run like we've just had.
When does it make sense to deploy new cash into equities? When does it make
I
sense
think
to move that cash that's earning 5% in a money market fund to equities?
Well, you just hit the point square on. Look at the rate of return and the risk-adjusted return. So let's take the S&P. It's 20 times earnings. If we invert that, right, and we take 1/20th, right, that's a quarter. So we're going to make, a 10 PE is 10%, okay? A 20 PE is 5%. And so we're getting 5% on stocks with growth, by the way. So pick an earnings growth number, a few percent with the economy. That's your rate of return. Well, if we're getting 5% on risk-free assets, the question is there enough of a risk premium in those stocks to take that risk? And I would tell you, you have to be very careful. I would also say that there's two different markets at the moment. Remember, 10 stocks are about 30-40% of the return of the market this year. So it's a narrow advance. So you've got this one group of stocks, which, by the way, everybody's chasing, where actually the PEs are astronomically higher, which means the rate of returns are lower versus this cash. So there is a place to put money. Small caps look interesting. Value looks interesting. International developed looks interesting. Emerging markets is starting to come up. You have to just be very discerning of your evaluations.
How do you defend staying on the sidelines, though, to clients? And not even you specifically, but how would you advise that defense? Because we have seen the NASDAQ up, 40% in the first half of this year. How do you not get into this magnificent seven?
Well, I think you just really hit a home point, right? We're neutral. And yet, to clients, that feels like we're on the sidelines.
Yeah.
and that even the language of saying, hey, just be neutral, and it's okay to hold 5% treasuries and be underweight, let's say, long-term bonds, which we are, that feels somehow we're on the sidelines. We're not. That's called prudent long-term asset management, right? That's called long-term strategy. I guess the question is, if we were to look back in time, 1999, 2000, 2007, 2008, 1971, going into 72 Nifty 50 crash, right? As we look back in time, everyone would say, hey, I want to sell when the markets are strong and be smart, and I want to buy when markets are down and be smart. And yet, because we're human beings, we continue to do the opposite.
Because we don't know when markets are up or down unless we, have a crystal ball or can, travel in time.
Or you use valuation, use fundamental valuation, right? It walks you through the process, and you have to have a long-term perspective and not be thinking short-term. It's really simple. And my point of view is this. I'm not suggesting you leave the market or you stand on the sidelines or you try to grab some dramatic moment to put it in. I'm saying with the markets run as far as it has, with the valuations, why be overweight?
Leo Kelly, we love it when you join us. Founder and CEO of Verdance Capital Advisors on the Zoom from Hunt Valley, Maryland. Have a great afternoon, Leo. Have a great weekend. We'll talk to you next time. You're listening to Bloomberg Business Week. This is Bloomberg.
your company news headlines on Bloomberg Radio.
From Bloomberg World Headquarters, I'm Charlie Pellet. We've got DraftKings shares higher after the online sportsbook posted second quarter sales that beat expectations. It also raised its forecast for the year. DraftKings is based in Boston. Shares higher now by about 5%. Shares of Block, that's Jack Dorsey's payments company, are plunging after reporting results that fell short of some analysts' expectations. Ticker is SQ Square. We've got Block shares down now by 14%. Apple's market value back below the historic $3 trillion level after the iPhone maker's outlook for the fourth quarter sparked worries over tepid demand for its handsets and other gadgets. Apple after earnings down now by 4.6%. And with more on the Apple story, here's Bloomberg's Ed Ludlow, who says Apple is not immune to the macro story.
What we got was a story where the smartphone market in the US is not strong. There were bright spots, and the numbers are mixed going into the rest of the year. So ultimately, Apple beat on fiscal third quarter revenue, the quarter ending in June, coming in overall at $81.8 billion, slightly ahead of expectations. But in the fiscal third quarter just gone, iPhone revenue was softer than expected. What it means, all told, is that this is the third consecutive quarter where Apple has experienced year-on-year declines, going back to 2016 for 3 consecutive quarters.
Bloomberg's Ed Ludlow. And again, we've got Apple shares down 4.7% after earnings. Amazon up now by 8.4%. Those are our top company stories at this hour, and this is Bloomberg.
This is Bloomberg Business Week with Carol Messer and Tim Stenbeck on Bloomberg Radio.
It is Bloomberg Business Week with Tim Stenbeck and Madison Mills in for Carol all week. Maddie, you know, we got some interesting stories today. We haven't touched on this one yet. This one's about Carl Icahn. His fortune falling $2.7 billion just today. This after the activist investor made corporate changes in response to a short seller's scathing report published 3 months ago.
Yeah, and, you know, we are very lucky here at Bloomberg with the terminal to have the Bloomberg Billionaires Index, right? So we can see right now on our terminals that Icahn's net worth dropped to a measly $7.8 billion. The Bloomberg Billionaires Index started tracking his net worth 11 years ago, so this is the lowest level it's been at since the index started tracking his wealth.
And less than a third of what it was all the way back in April. Yeah. Remember what happened then? So what happened today was the company announced that it was slashing its dividend in half to $1 per share. That was a key target of short seller Hindenburg Research's allegations. That was a few months ago, back in May. It included claims that the company was overvalued and that Icahn's practice of leveraging his shares left it exposed in a downturn.
Yeah, and part of why they drew the attention of Hindenburg Research, which does typically look at retail investment opportunities, is because Icahn's $2 dividend was appealing to that exact group of retail investors. But Hindenburg did claim that kind of the main reason the company could afford the hefty payout was because Icahn took his payment in the form of new shares there. So that's part of those kind of allegations from Hindenburg there.
Yeah, Hindenburg alleged that was the only way to make the dividend possible since Icahn Enterprises was consistently operating with negative cash flows.
You know what's interesting, Tim?
Tell me.
This goes back to, I'm switching gears a little bit.
That's fine.
In May, Bill Ackman, do you remember when he started beefing with Carl Icahn, saying that Carl Icahn needed a friend?
Maddie, I was checked out then.
Good point.
I do not remember that. I'll be honest.
Really sorry. I mean, listen, this was not a news story that you needed to be worried about, okay? Bill Ackman just posted a long tweet back in May, kind of talking about Icahn Enterprises.
That's when Twitter was called Twitter.
That's back when Twitter was called Twitter, so I'm not even wrong, even though I refuse to call it X. So just a good reminder, there's always billionaire drama going on, guys.
And Maddie's bringing us the latest. Well, coming up next, we're going to be joined by our Bloomberg TV team for our cross-platform coverage on radio, TV, YouTube, and on Bloomberg Originals. Beyond the Bell starts now.
Some sort of retracement as we move closer to the closing bells here on this Friday afternoon. Full market coverage right here on Bloomberg as we take you to the bell and beyond.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic alongside Scarlett Fu. We're counting you down to the closing bell. You're here to help take us beyond the bell. It's a global simulcast with our friends Madison Mills and Tim Stenovic. Welcome to our audiences across Bloomberg Television, Radio Originals, and our partnership on YouTube. A big flip-flop over the last couple of hours, Tim, Maddie, in the markets, where we've gone from green to red across the board here on what's going to end up being another down week.
Yeah, obviously with Apple being the biggest component of the S&P 500 and falling by over 4.7%, that turns into a big loss for the index and kind of drags down the entire sector. I'm curious, too, whether we're going to see sort of dragging down in the overall AI space, given that that's such a key part of this rally that we've seen, Tim, so far this year.
Well, I want to bring in our comments from Leo Kelly, the founder and CEO of Verdance Capital Advisors. He just joined us. And he said that there's this razor-thin line of perfection that's getting tighter and tighter because the S&P 500 and the NASDAQ are just priced for perfection right now. And the issue yesterday that's leading to the sell-off today was Apple missing on those iPhone numbers. Just that one little thing because of Apple's size, Maddie, and because of the way the market's priced for perfection, that sends everything lower.
Yeah, absolutely. And it's interesting, Scar, when we think about, too, this jobs data that we got this morning and what that tells us about the consumer as well.
Yeah, well, the labor market is cooling. That's what the jobs report showed us, but it is in an orderly way. And if you certainly compare it to the pre-pandemic times, it's still fairly strong. What's interesting here is you would think on a day like today, Friday afternoon, after some of the biggest companies reported their earnings, that volume would be below average. It's not. It's above the 10-day average.
Yeah, when you see that uptick on the volume on a day where you get the stocks moving to the downside here, well, look out below here. Maybe some concerns going forward as we head into the next week. The Dow Jones Industrial Average down about 150 points roughly on the day, right around that 35,000 level, down about 0.4% here on the day. The S&P 500 lower for a fourth straight day, lower on the week as well. On the day, it's a 0.5% decline. Similar story for the NASDAQ, down for a fourth day by about 0.4% here on this Friday. And let's take a quick look at the Russell 2000, also down for a fourth straight day, only by about 0.2%, but across the board, we're in the red on a weekly basis.
Yeah, there's something for everyone when you look at some of the news and data that we got this week. You have the Atlanta Fed GDP now jumping at 3.9% this week for the third quarter. Then you have productivity up to 3.7%. That's the highest level since the third quarter of 2020. And then today, you've got Bank of America and then today JP Morgan, both taking recession calls off the table here. And then you've got the jobs report, you know, a mixed bag, but still seeing some good news both for the Fed and for consumers, Scar.
And it initially lifted the market, but as the afternoon wore on, we saw Apple drag everything lower. I'm taking a look at the group ranked returns for the S&P 500. If you split it up into 2 dozen groups and look at the retailers at the very top there, up by 4.3%, that is Amazon. And then you look at consumer durables and apparel. That, of course, is some of the VF Corp and home builders. And then you move on and you look at the very bottom, tech, hardware, and equipment, all of that is Apple. Apple dragging that group down by more than 4%.
Yeah, well, Scar, I want to go back to the positives here and look at some of our gainers, starting with Warner Brothers Discovery announcing that they're close to offering an expanded slate of live sports to Max, formerly HBO Max, of course. This gives them a chance to offer consumers another more expensive subscription offering that could be, you know, a boon for them in terms of revenue, but also they're going to have a lot of competition in the space. Also today, a Bank of America note on Warner Brothers saying that this could be a dividend play, particularly because of their robust cash flow. And then, of course, I've got to talk about Amazon, obviously the huge gainer of the day, driving better margins from decreased costs, getting quicker, more effective, and cheaper cardboard box deliveries, as Tom Keene likes to call them. Definitely back to pre-pandemic levels for the brand. Also, a lot of potential revenue streams, as we were talking about earlier today, Scarlett, with The Summer I Turned Pretty on Amazon Prime. Everyone's got to watch it this weekend. So a lot of potential revenue streams there for Amazon. And then I want to end on Arista Networks because this was the best performer of the week, coming off its lowest lows ever. Arista sells those switches that speed up communications among racks of computer servers that are packed into internet data centers. So they've got great earnings. This is an AI name, and their biggest customers, Tim, are Meta and Microsoft. So good for those names as well.
All right, you got the gainers, I got the decliners. I want to start with Apple. We've been talking about the results all day. The worst day for the company stocks in September of 2022, down 4.8%. On a points basis, the biggest decliner in the S&P 500. Of course, a mixed quarter for the company. iPhone sales revenue disappointment. Services revenue setting a record for the June quarter. The company also giving an outlook for the current quarter. Worried analysts that demand for iPods and Macs will be sluggish. The company said, hey, tough comps with a year ago when everybody was buying, but still analysts were disappointed. Fortinet, the worst performer in the S&P 500 on a percentage basis, down 25% today. The biggest decline on record, cut its revenue and billings guidance for the year. It's a cybersecurity firm. The big question from analysts, is this the start of a more prolonged slowdown when it comes to demand for these services? And then Nikola falling 26%, losses accelerating later in the day. This is after the electric truck maker named Stephen Gursey as its new CEO. We should note this year through Thursday, the stock was up more than 57%, but giving back a good bit of those gains on today's tumble.
Of course, a lot of the moves that we saw today and this week were directly correlated with what we saw in the Treasury space here. Some interesting moves here, particularly in the belly of the curve. A 5-year yield was up about, something like 14, 15 basis points on the day here. So interesting to see a re-embrace here in the Treasury space, despite the sell-off that we had seen to start the week. Your 10-year yield up about 13 basis points here on the day, and even out on the longer end of the curve here, I should say down on the day, excuse me, and your 30-year yield down 9 basis points on the day, Scarlett.
Yeah, and one thing to keep in mind is we have a lot of Treasury supply next week as well. So that's going to add to the rate volatility that we've already seen this week, which has been pretty mammoth moves, especially if you look at like the 10-year yesterday.
Yeah, well, and Scarlett, it's interesting when you talk about today because we keep saying that there was a little something for everyone, right? And I kind of feel the same way about the big tech names because you had Amazon beating expectations with record Prime Day sales, for example, but iPhone sales down. So I have to wonder when I'm thinking about where to kind of place the consumer in terms of spending, it just feels like you can pick data points on either side for all of these questions, Tim.
But you go back to some of the earnings, and I mean, particularly some of the secondary ones, because we were kind of talking a little bit earlier on the TV program. Was it WW, the company formerly as Weight Watchers? There were a couple other kind of consumer-facing companies here that clearly were struggling there when we talk about, at least in terms of the results, some of the real estate companies like Open Door and Redfin. Yeah. So there's pockets of this economy, particularly when it comes to consumer spending, that really isn't holding up. So I don't know where you get the picture of that softish landing. I guess if you look only at the labor market, yeah, it's there. But if you look elsewhere, I don't know. You can make a case that maybe this could be hard.
Yeah, that's a really good point. It brings us back to the conversation that we had with Poonam Goyal at Bloomberg Intelligence yesterday in the wake of Amazon earnings. She said that customers here in the U.S., they're not strapped. What they are doing is they're discerning. Mm-hmm. They're choosing very carefully what they buy. They're not necessarily trading down, but they're just very careful about what they're buying right now. Look, we get a slew of economic data next week. We get a couple more earnings next week, Scarlett, with Disney and other SoftBank as well. So we'll get, different sort of reads in different areas of the economy and a little bit of entertainment and where people are spending their money. It'll be interesting to hear if we get, how the numbers at Parks and Entertainment Division are as a result of if people are spending their money there.
Well, we've already heard that Disney, I think it was the 4th of July, saw very little traffic at its parks in California and in Florida. So that's an indication that all the price increases that they've implemented after the pandemic is starting to not scare people away, but put people off a little bit.
Yeah, it'll be interesting to see. But, I don't know. It's if we're trying to sort of read this just through the lens of the economy, meaning trying to extrapolate what's going on with corporations, or you want to do the reversal of that here, is what we're talking about, or what we're seeing, I should say, is that really accurate? An accurate picture, I should say.
Well, I feel like, Romaine, you probably got a good read on the economy when you were in Alabama for about 24 hours for NABJ. Did you notice anything?
I was there for 36 hours. And and you want to know what all the talk was?
What was it?
Oh, my gosh. All the talk?
The weather? It was hot?
Alabama football.
Oh, no.
Yeah, nobody cares about the economy. Nobody cares about anything down there. It's like just football and more football and more football.
So there's plenty of spending on the football program there, right?
Yeah, well, football's doing great. I mean, if you're looking for a bright spot in our economy, Alabama football is on the fire.
Hey, experience
Can you
spending
invest?
is up.
There's
Can you invest in the Crimson Tide? Because that might be a good bet based on what I saw down there. In all seriousness, though, too, I mean, just anytime you go traveling, you kind of get a good read, too, of kind of what's going on here. And look, this is just anecdotal, but The airports are full. I came off the airport today, a Friday morning, and it was packed at the New York airports here. People looking to go wherever they're going.
Every airport I've been to over the last 2 years just feels like it's too small for the area that it's in.
Oh, well, you certainly haven't been to the Birmingham airport.
Was it not crowded at all?
I'm saying it's small.
Okay, well, everything. No, that's what I'm saying. Everything is too tiny.
They did have a
people
Chick-fil-A.
everywhere.
That's
There's
about
not
it.
seats.
Tim Stanovic has
There's
some
this imbalance.
feedback for our transportation
There's
department.
still an imbalance going on, guys. We're not back to the norm yet.
Still an imbalance there. And don't forget, Bloomberg News reporting that U.S. domestic trips, the flights, getting a little bit cheaper, you guys. So
Where's
get
Carol
those
Master?
flights
I thought
now,
she'd
you
be
guys.
back by now.
No,
she's back for you next week. Don't
Of the
worry.
cheaper domestic fares. How about that?
Don't worry. Carol's going to be back with you here next week. But guys, that is going to do it
I wasn't
for...
asking for her to come back. I just wanted to know where she was.
Oh, I understand. I understand. Well,
All right, we gotta
she's
go.
on vacation. We have to go. That does it for our coverage. Reminder that Bloomberg Business Week, it's now on Bloomberg Originals. We're going to see you next week, you guys. Have a great weekend.
This is Bloomberg Business Week with Carol Massar and Tim Stanovic on Bloomberg Radio.
All right, everyone. Madison Mills and Tim Stanovic in our Bloomberg Interactive Brokers studio, coming off our simulcast here to talk about a really important story, particularly for our audience and our industry here, Tim, because tomorrow is a very big day. Warren Buffett's conglomerate reports second quarter earnings on Saturday. Along with earnings, we're going to get insight into their insurance businesses, stock picks, buybacks, and of course, as always, some Buffett commentary. So here to discuss is the Berkshire watcher himself, Max Reyes. He's Bloomberg's regional banks and insurance reporter. And Max, thank you for joining us on this Friday afternoon, especially when I know you've got to get up early on your Saturday morning to cover this for us here. Talk to me about what the single most important thing is that you're going to be listening in for when it comes to Berkshire tomorrow morning.
Yeah, happy to. I would say that for this quarter, the big thing is kind of the read for the U.S. economy, just because Berkshire does have two very important quarters kind of earlier in the year. The first quarter, we get the annual letter, and then, later on in the year, in May, we go to Omaha and actually get to see Mr. Buffett himself and get the whole song and dance at the annual meeting. But this quarter is less exciting in that sense. But the kind of read-through for the economy, I think, will be the most important thing coming out of these results.
What do you expect Buffett to say about the economy? What do you expect Berkshire Hathaway to say about the economy?
I don't necessarily expect Buffett to say a whole lot, just because I would say his kind of quips and his commentary in the actual releases have been a bit more subdued of late. But I do think the results from Berkshire will tell us a lot about how the various businesses they operate in are doing, right? Like we've seen in the past year, various business lines take a hit off of inflation. And given how exposed the company is to different aspects of the economy in different ways, right? Like they handle freight, they, sell consumer products, all sorts of different sort of, verticals, avenues into the broader economy. I think that will be the most interesting thing coming out of that.
Okay, let's talk about Occidental Petroleum.
What do you want to know?
Sorry?
I said, what do you want to know?
Well, Berkshire Hathaway, now, I was shocked to see this. You just used the HDS function on the Bloomberg terminal. I remember when Berkshire bought into this, over the last couple of years. Now it has a 25% position in Occidental Petroleum. This is a company that's only up 0.8% on the year. What's going on? I mean, we know what's happening in the oil industry this year. We know what happened last year and the year before. Tell us about your view of Warren Buffett in energy right now.
Sure. I think I wish my colleague Kevin Crowley was here, just because I worked with him on this story that explained it really well. But basically, energy is where you're seeing the cash flows. Even though these stocks might not be trading at a premium, they are kind of delivering the dividends and the long-term value that Buffett loves, right? That is sort of his bread and butter. So the reason we're seeing him pour so much cash into building out a stake in Occidental, the reason we're seeing Berkshire Energy invest so much in these various different kind of energy bets is because it makes sense for what Buffett's doing, right? It's the kind of long-term strategy, kind of long-term game he's always been playing.
Well, talk to me then about what we might learn about his long-term game.
I was hoping you were just going to ask about See's Candy.
Oh, yeah.
It's just a small
I mean,
one.
Max, do
It's
you
a
have
small
anything
little
to
player,
add about
Max.
what he might say about
From
See's
oil
Candy?
to See's Candy.
Yeah.
Do you like
I
it?
I did, but I'm a fan.
I am too. I grew up with it.
Oh, yeah, California guy.
Yeah.
Yeah. When I was at the Berkshire annual meeting, I bought myself a block of fudge that I ate alone in my hotel room over the course of a few hours. So I'm a fan.
Okay, that's great color. That's great.
That's incredible. I really hope that you put that on your corporate card. Not going to make you say whether or not you did on the air, but I hope for your sake that
on my
you did.
resume for sure.
Okay, good.
Yeah, it's on the room. It's on the room. But Max, what can we anticipate in terms of commentary from the man himself tomorrow?
Yeah, I would say that it tends to be a little shy in this quarter. It tends to be a little scarce in terms of commentary beyond what we're hearing about the businesses. So we might get a sense of, oh, this business is struggling with prices. We might get a better sense of inflation, how it's weighing on results one way or the other. But Buffett himself doesn't necessarily say a whole lot on a quarter-by-quarter basis, unless it's the annual meeting or the annual letter.
What about when it comes to the insurance industry and the challenges the insurance industry has faced, not just because of climate change, but because of rising costs associated with more claims?
Yeah, so looking at last year, I believe that we saw Geico basically turn a loss rather than a profit because of exactly what you're talking about. It's more expensive to repair or replace a damaged vehicle. The accidents people are getting into are more severe. You're paying more, basically, in terms of legal fees in case someone else is injured, which is all to say that insurance, which Warren Buffett loves because it creates this kind of surplus of cash he can then use to invest in other opportunities. That's kind of what the model was built around. But that is to say that this insurance business that he's long loved is kind of been struggling. And it's not going to struggle forever. That's not how the industry works. But it is going to be a pain point. We did see Geico turn a profit last quarter after, I want to say, 6 quarters without one. But this quarter so far, second quarter, has seen really elevated losses from catastrophes, from natural disasters, and that could end up, weighing down on results.
What about Apple?
Yeah, it's been doing well for him. it's Berkshire's biggest investment in terms of just like market share, which is saying a lot because Buffett has a lot of different stocks he puts his cash into, right? So what analysts are expecting to see is gains from that investment kind of buoying the rest of the investment portfolio. But yeah, Apple is likely to perform well for Buffett in this quarter.
Isn't that kind of surprising? I mean, I remember when Warren Buffett actually got into Apple for the first time. It wasn't even that long ago. It's pretty incredible how he's built his position in the company just in the last few years and how, at the time, everybody said he's kind of late to this.
Yeah, I don't think that perspective has changed necessarily. I think that, Buffett will be the first person to admit he kind of came to technology and to Apple in particular a little late into the game. But it's obviously been working for him. He's been very happy with it, and he said as much, multiple times. At the annual meeting, there's this big kind of, not slideshow, but a series of clips that they show at the beginning. And one of those clips is just a, commercial for Apple, which really, I think, speaks to how much he likes the stock, how much he wants everyone to know how much he likes the stock, that sort of thing.
Yeah, it's incredible. Again, going to the HDS page for Apple, Berkshire Hathaway is the 3rd largest individual shareholder after Vanguard Group and BlackRock. Berkshire Hathaway has a $166.63 billion position, Maddie, in Apple.
That's big.
Huge.
Big.
Okay, Max, before we let you go, ever any surprises at these things?
That's $1 million question, right? And I'm not going to say no, because if I do, I'll be jinxed and I'll be working until like 8 p.m. tomorrow.
Oh, no.
but it's the kind of thing where one criticism that has been leveled at Berkshire is that they're not the best at communication. They're not necessarily the best at being super transparent with investors as to what's coming down the pipe.
Right.
So whenever we get one of these results, we're always on high alert in case there is a surprise. But the thing that makes them surprising is there's no way to know.
I encourage everyone to check out Berkshire Hathaway's website for a lesson in communication, because this thing looks like it's 30 years old. Max Reyes, Always good when you join us. Really appreciate you taking the time. Good luck tomorrow covering the Berkshire Hathaway quarterly meeting. You're listening to Bloomberg Business Week.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 421 on Wall Street. We do check markets all day long here at Bloomberg. A move lower today for the Dow, the S&P, NASDAQ, and the NASDAQ 100 index. Stocks fell as Apple dipped below the $3 trillion mark, and some other mega caps like Tesla and Meta Platforms slipped as well. Amazon, though, rallied after its results. Today we did see Amazon shares surging. Amazon, after earnings today, did gain by 8.3%. Bottom line here, a lot of red on the screen, with the S&P 500 index wiping out a 1% gain, falling by 0.5%, ending the week heading into the weekend at 4478, down today by 23 points. The Dow down 150, down 0.4%. NASDAQ lower by 50, a decline of 0.4%. 10-year yield 4.03%, with the 2-year yielding 4.76%. Spot gold up $8 the ounce to $19.41, higher by about 0.4%. And West Texas Intermediate crude oil up 1.3%, $82.64. $1,854 a barrel. Well, as for the overall market backdrop, Leo Kelly is the CEO of Verdance Capital Advisors, and he was a guest right here on Bloomberg Business Week.
I think we're in one of those periods where we're so optimistic right now that the market just wants everything to be good news. And so just slight concerns are really going to have a negative impact on the market.
Again, case in point, Apple shares down today by 4.8%. By the way, you can hear more of that conversation on the Bloomberg Business Week podcast. You can download it wherever you get your podcasts. Icon Enterprise shares plunged today by 23.2%. Carl Icahn slashed his company's quarterly payouts in half and pledged to, quote, stick to our knitting in another move, acknowledging complaints raised by short seller Hindenburg Research earlier in the year. Recapping a down Friday, S&P fell 23 points, down 0.5%. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
Hey, thank you so much for that update, Charlie Pellet. Really do appreciate it. Maddie, we've gone, almost this whole week without talking much about Bitcoin.
I mean, I can't believe you've been able to do it, Tim.
I know. Well, I've been saving it for this afternoon because it's our weekly segment where we talk about cryptocurrencies. Very pleased right now to have Munib Ali joining us. He's the co-founder and CEO of Trust Machines, also the co-founder of Stacks. Munib joins us via Zoom. Good to have you with us this afternoon, Munib. I'm on your website for Trust Machines, and what you promised to do is build a decentralized economy on Bitcoin. I think what people understand about Bitcoin and cryptocurrency is how we can use it as a currency, but I don't think a lot of people understand how you can build on it. What do you mean by that?
Yeah, absolutely. Thanks for having me. So I think if Bitcoin is money, so what we are talking about is building the entire financial infrastructure and financial markets around it. And we've actually seen early signs of that in other ecosystems like Ethereum and Solana. But Bitcoin happens to be the largest network, the most durable, the most recognizable brand. And I think it's sort of like surprising that so far we haven't seen more financial infrastructure built around Bitcoin itself.
Like what would you think that should be built on it right now?
I think the things that come to mind, first of all, are decentralized exchanges. Obviously, we know about Coinbase, and we've seen the FTX blow up. So if things are decentralized, if people can just trade in a decentralized way, that's really good. Even bringing stable coins to Bitcoin. Most of the stable coins like Tether and USDC, right now they're issued on Ethereum and some other chains, and they're not really sort of like working on the Bitcoin rails. And I think bringing stable coins to Bitcoin, building lending protocols, again, we saw things like BlockFi blow up. So if there were decentralized lending protocols directly built on top of Bitcoin, I think people could have really benefited from that.
When you think about the trade of Bitcoin, it seems like it's losing its mojo a little bit, right? When we look at it year to date, we're not seeing as much of the volatility that you usually see when it comes to Bitcoin. It's gone 8 trading sessions as of today without a 1% move. What does that tell you? Are you concerned at all about Bitcoin as kind of an asset class?
So this is my 3rd bear market, right? And I think this is probably the most pleasant bear market that I've been through. So I consider us to be in a bear market. I think given for a bear market, this is actually a pretty good trading market to be in. Things aren't looking that gloomy. And I think I would be just looking forward to the Bitcoin halving, which is scheduled for April next year. I think historically, again, this is how the market has been working. No guarantee it will work like that in the future. But historically, around the Bitcoin halving is when markets pick up. There's a lot more excitement, and because it's just the market dynamics. The supply of Bitcoin goes down even more, and I think people get more interested in it.
Well, what's interesting though, when it comes to what markets are more interested in, is that we have this really cool word search function on the terminal. If you want to nerd out with me for a second.
I do. I don't know what you're talking about.
And it looks great. Well, you can do DSGO to document search, but smarter people than me just write it up for me, so I don't even have to use the function, to be honest. But one of the reports from this week looks at how Barbie mentions outbeat Bitcoin for mentions on the terminal this week. So, and that's the 2nd week in a row that that's happened, by the way. So what does that tell you? Does Bitcoin have a PR problem? Do they need to become a Barbenheimer to get back into the zeitgeist here?
Yeah, so I think I'll go back to this 4-year cycle theory, right? So we see these spikes. Bitcoin basically does a 10x or so, right, in terms of number of users. In the first cycle, we went to like 1 million users, then 10, and depending on how you count, maybe the last one was getting closer to 100. So I think the interest goes down as well, but this is the time for builders, right? So this is something I've seen over and over, that companies and developers who really believe in the technology, they basically catch up on things during this bear market cycle, right? So a lot of great products get built. A lot of people were basically building for the next years. They get their work done, and then the next wave of interest comes. So I think we're definitely in a bear market.
What are you seeing built right now?
Yeah, so some of the things that I'm really excited about is Bitcoin L2s. If you look at Ethereum, it's something like a $250 billion market, and it has a $50 to $60 billion L2 markets. L2s are these layer 2s that are built on top of Ethereum. They help it scale, they bring more users and applications to it. And for the first time, I'm seeing more of that happening on Bitcoin, which is absolutely critical. So you mentioned the Stacks project. I'm a co-creator of it. Stacks is a Bitcoin L2 that helps sort of like bring more applications, or being able to just do like cheap and fast Bitcoin transfers. They will happen on the L2s and not on the L1. And I think these are still maturing more on the Bitcoin side, but some pretty exciting stuff happening.
Given that we're still in what you describe as a bear market, or what others describe as a crypto winter, are you seeing interest around the space just cool? I mean, Maddie brought this up about Barbie versus Bitcoin, but are you having trouble finding employees? A couple years ago, what we were talking about was, hey, these are all people leaving Wall Street to go work at crypto firms.
Yes. So I think the one interesting dynamic of what happens during the bear market is Bitcoin dominance actually goes up. So some people who track the Bitcoin dominance, it's actually at the highest right now, which just means the market cap of Bitcoin versus all the other assets. So in some ways, it actually becomes easier to hire for Bitcoin companies because people get more burned by all the other assets, right? That might be riskier, or there might be all sorts of nefarious people behind those projects. Where Bitcoin is this neutral, truly decentralized grassroots movement, and people gravitate towards that a little bit more. This is within the crypto industry, but broadly speaking, yes, I think it's not the crazy times, but sometimes it's also a really good filter, because now you're not getting the mercenaries. You're actually getting more mission-driven people who actually believe in decentralization, who believe that building these trusted systems is actually a good thing. So I've always enjoyed the bear markets. I think the signal-to-noise ratio actually improves a lot. There's a lot more signal in the market, and so drifters, they go away. I think they're going to AI these days, and
that's the way this is. That signal or noise in AI, though?
I think as a computer scientist, I'm definitely interested in a lot of the breakthroughs that have happened recently. I wasn't a believer like 5 years ago, but I've seen some really good stuff come out. But again, it's like the overhyping of something and people just jumping on the bandwagon stuff that we need to be a little bit careful of.
Hey, what's it going to take, Muneeb, to get crypto out of this winter?
I think I am a firm believer in Bitcoin first. I think the rest of the industry is sort of like attached to it. Bitcoin has a clear product market fit. I mean, we're seeing the turbulence in the financial markets. We're seeing inflation just go through the roof throughout the world. Like, I think it's not just in the United States. Like, I have my parents who live in Pakistan, and whenever I send dollars to them, a dollar is worth like 3x more just in the last 2 years than what it used to be. So people are feeling the pain, they're feeling inflation, and they're realizing what a hard asset means, what a gold-backed currency could have meant. And I think Bitcoin is sort of like the best thing out there. And what happens is, whenever interest in Bitcoin goes up, then there's a long tail of everything else that sort of like picks up on it, right? So I feel like if you believe in Bitcoin, if you think the world needs a better money, and Bitcoin is the best money invented so far, and it's almost like an open source thing, right? It's a technology that's out of the box, very hard to stop. So I think when Bitcoin rises, everything else is going to rise with it.
All right, well, we're going to have to leave it there on this Friday, Muneeb. Thank you so much for joining us, Muneeb Ali, co-founder and chief executive officer of Trust Machines. I should mention, you're also the co-founder of Stacks, coming on to talk crypto with us for our weekly crypto segment, Tim.
All right, well, we don't forget about equities here, even when we're talking crypto. And let's just take a look at how things closed on the day today. The Dow finishing the day down by 0.4%. The S&P down by 0.5 percentage point today. The NASDAQ down by a little more than 0.3%. On the week, Maddie, we finished down more than 1% on the Dow. The S&P 500 down 2.3%, and the NASDAQ down by 2.9%. Let's go from New York City to Washington, D.C. for a check on the latest world and national news. Nancy Lyons in the Bloomberg 99.1 newsroom. Hey, Nance.
Hey, Tim. 9 members of Congress, Democrats and Republicans, walked through the halls of Marjorie Stoneman Douglas High School in Parkland, Florida today. They were joined by the parents of the 17 people who were killed in the 2018 mass shooting at the school. Max Schachter lost his son, Alex.
I'm rejuvenated in thinking that there's a lot of agreement here that we can come together on and to make our schools safer and prevent this from ever happening again.
Schachter says they wanted to bring lawmakers through the blood-stained and bullet-riddled building to show them the failures of current gun policy. Following the tour, a reenactment of the massacre was conducted as part of a civil suit against the former sheriff's deputy who was assigned to the building on the day of the shooting. Michael Bloomberg, the founder and majority owner of Bloomberg LP, the parent of Bloomberg Radio, is a donor to groups that support gun control, including Everytown for Gun Safety. The record heat waves in much of Europe and the U.S. do not seem to be having an impact on tourism. We get more from Bloomberg's Irv Chapman.
Changing climate may change travel destinations over time, but it hasn't happened yet. Glenn Fogel, chief executive of Bookings.com, said in a Bloomberg interview.
People have historically thought, well, I'm going to do my travel in the summer. I'm going to go to the places that I want to see, not recognizing those places may be very, very warm. Certain areas that are cooler right now, like Scandinavia, there's going to be more travel to those types of places.
The travel surge that hit the United States in the last year, Fogel said, is now occurring in Asia, which lifted COVID restrictions later. In Washington, Irv Chapman, Bloomberg Radio.
Lottery players are hoping luck is on their side tonight as they try and win the 4th largest jackpot in Mega Millions history. The top prize has now risen to $1.3 billion after no one claimed the jackpot on Tuesday. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Nancy Lyons. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 4:40 on Wall Street. We do check markets all day long at Bloomberg. A down Friday, losing week as well. On the week, we had the S&P 500 index down 2.3%. Today, the S&P fell 0.5%, lower by 23 points. A drop there today of just about 0.5%. Again, the S&P down almost 24 points. The Dow today fell 0.4%, lower by 150 points. NASDAQ down 50, a drop there of 0.4%. To put this all in context, at one point, we had the S&P 500 index up by almost 1%. 10-year yield, 4.03%, with a 2-year that's yielding 4.76%. Spot gold up $8 the ounce to $19.42, a gain of 0.4%. West Texas Intermediate crude oil up 1.2%, $82.54 for a barrel of WTI. Jobs Friday, as I mentioned, and there was something for every bull and every bear in today's data. The 187,000 growth in payrolls was softer than estimated. Wages, though, top forecast. Unemployment fell. Austin Goolsbee is the president and CEO of the Federal Reserve Bank of Chicago.
It was pretty much what we expected. I mean, let's remember, the jobs number is whatever it is, plus or minus 120,000 a month. So there's no point quibbling over numbers. The job market is cooling a little to kind of a balanced level, but it's still extremely strong. That's the strongest part of the economy by far, is how low the unemployment rate is, and people can get a job if they want a job.
And you can hear more of that conversation on the Bloomberg Markets podcast. You can download it wherever you get your podcasts. Icon Enterprises shares plunged today. We had that stock down by 23.2%. Carl Icahn slashed his company's quarterly payouts in half and pledged to, quote, stick to our knitting in another move, acknowledging complaints raised by short seller Hindenburg Research earlier this year. Apple after earnings down 4.8%. Amazon after earnings up 8.3%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
Thank you so much for that update, Charlie Pellet. Really appreciate you taking the time and bringing us the latest when it comes to all things business news. Well, very lucky to have with us this afternoon a trio of CEOs. We're to our second right now, and it's the CEO of the enterprise cloud data management provider Informatica. The company reporting results on Wednesday. Investors and analysts, well, they really liked what they saw. Informatica boosted its adjusted operating profit guidance for the full year, the guidance beating the average analyst estimate. And Maddie, yesterday's shares surged to close more than 16% higher and continued higher today by another 1.6%. We've got the company's CEO, Amit Walia, joining us right now this afternoon. Good to have you with us, Amit. It's good to have you. It's good to talk to you again. It's been more than a year since we last connected. What worked out so well for you for the quarter, and what's your outlook for the year?
A pleasure to be on the show, Tim. Thanks for having me. Well, we had a great quarter and a great first half. Well, I think, look, we've been a company that has flipped to the cloud business model, all led by our platform, Intelligent Data Management Cloud. And what the analysts saw and they've been expecting is that we exceeded our expectations for growth in the top line. Our cloud ARR grew 37%. And obviously, in these transitions, people typically lose profitability. We actually exceeded our non-GAAP operating income and our unlevered free cash flow, and we raised the guidance for that for the year. So I think growth on the top line, boosting the bottom line, I think in a time like this, that's hard to do, and that's what our teams accomplished.
Well, that's the great news. I do want to read you from Citi's take on your earnings. They describe the fundamentals as still underwhelming, with aggregate growth continuing to decelerate. But having said that, they do have a great outlook on the stock. So talk to me about how you would respond to that. What would you say about the fundamentals?
Well, thank you, Madison. Well, look, I think when you're going through a cloud business transition, that's why our investors focus on ARR. Revenue always takes a hit because of the whole accounting revenue recognition. And I think this year, our revenue from an accounting point of view has taken the hit because of obviously the cloud ratable recognition model. But the cloud business that's growing very well sets up very well for as we look forward, finishing this transition this year. So that's what it is. But it smooths out and look at ARR. It basically shows you that the intrinsic business grew very handsomely when you look at the entire cloud industry, growing 37% was ahead of the market.
Amit, what are you hearing from customers right now? We talked earlier in our program about advertising companies seeing a pullback in advertising from some of the biggest tech firms. We've seen some of the biggest tech firms do a massive number of layoffs just this year. What are you hearing from your customers?
Well, I think, look, if you step back and look at the enterprise software market, customers are generally cautious. I think stock market is a different performer than how enterprise IT budgets are. I think people are thoughtfully spending. It's still a very cautious environment. There's deal velocity is still not as it was before. All of those things are happening. But what's happening in that is people are prioritizing their spend towards things that can be accretive to the top line or to the bottom line. And areas like data analytics, security, those are the things that move up the stack. And that's what I'm hearing. And of course, right now, Gen AI is there. Clearly, everybody's talking about it. And I think when I talk to enterprise customers, they are in the middle of, so where of all the things that I can do, how do I begin? Where do I begin? Which technologies do I bet on? And very worried about all the governance aspects of Gen AI. Those are some of the biggest things that I'm hearing from customers globally.
One thing that I can't stop thinking about too, and I can't wait to get your take on, is companies that are changing up their capital allocation when it comes to their IT spend to invest in AI so that they can ride the AI rally and wave here. I wonder what your take is on who should not be over investing in AI right now. Are there any types of firms, companies that you think shouldn't be over investing in AI and should stick to their typical IT spend?
Madison's a great question. I'll say AI or Gen AI in particular right now, tremendously overhyped in the short term, and I would say tremendously underestimated in the long term.
Well, so explain what you mean by that.
Well, I mean, like the hype cycle around that is so high that to the point that you were saying that people may walk into it with eyes closed because it's just a shiny object to go do something. And to me, the thoughtful way to do something about, first of all, it's going to be an inflection curve. It will help companies both increase productivity and increase intelligence driving the entire P&L. But you need to be thoughtful about it. Where do you spend? Which projects? Are they going to drive the revenue line or the bottom line? An example for that is we have our Claire GPT, our own Claire engine, which is part of our platform, the GPT version of that, where customers are in private preview working with it, where insurance companies looking at the claims, fraudulent claims that they get, can they increase the preciseness or efficiency of that from 88% to mid-90s? And that's a massive revenue boost. So I think companies have to figure out which use cases matter and don't just walk into it just because it's right now the shiny object.
You said that it's underestimated long term. When are we going to start to feel the power that AI has, in your view?
I think we'll see it in next year. I think enterprises are always a step or two behind consumers. All of us have used ChatGPT. My kids are using it. You and I are probably using it. It's very easy to do. It's the free data of the internet that we can access. But if I'm an enterprise, it's your data. Privacy, governance are huge issues around it, so on and so forth. I know our customers are playing with our product around GPT. You will see use cases next year where they will get tangible value out of it. But like anything, it'll take a curve. And I do think that the next 18 months are going to be very, very monumental. And I think they'll be fun because we will see value coming out of it.
How are you attracting and retaining talent just in the last 45 seconds that we have with you?
I think, look, always focus on innovating. Innovation attracts talent. We are blessed that in the world we live in, data analytics, it's the hot space to be. So, talent wants to work on those innovative projects, especially in the world of AI. There is no AI without data. So we've been benefiting by these trends that are benefiting our ability to hire good talent.
All right, I think we're going to have to leave it there. Really appreciate you taking the time this afternoon. Amit Walia, good to talk to you. Like I said, it's been over a year since we last spoke. Really appreciate you joining us and taking us through the numbers. And also the outlook on AI for the remainder of the year. That's the CEO of Informatica, Amit Walia, joining us on this Friday afternoon. As a reminder, the enterprise cloud data management provider reported results on Wednesday. Shares absolutely surging earlier this week. On Thursday, they were up 16%, up another 1.6 today in a down market. So it's been a pretty good week for the company.
Yeah, and it looks like they've got 9 buys and 5 holds, 0 sells right now, Tim. So good week for them.
Well, we got a good week for us, Maddie, and we're not even halfway done with the show. This is Bloomberg.
your company news headlines on Bloomberg Radio.
From Bloomberg World headquarters, I'm Charlie Pellet. Sources tell Bloomberg Yellow Corp is considering a sale of assets and real estate through a bankruptcy filing, which may come as soon as this weekend. Fortinet shares plunged 25% today after earnings. A pullback in tech spending forced the cybersecurity provider to cut its annual forecast. Fortinet blames a slowdown in customers' information technology spending as they cope with a shaky economy. Amazon shares surged after last night's earnings report. Today we had Amazon stock up by 8.3%. Second quarter revenue increased 11% to $134.4 billion, topping estimates. Sales in the online stores category increased 4% to $53 billion. Anurag Rana is with Bloomberg Intelligence, and earlier today on Bloomberg Markets, he told us he is focusing on Amazon Web Services.
We just put a note out. We think next year AWS growth is going to be north of 20%. Market consensus still is about 14-15%. We think we should see a good rebound, not just in growth rate, but margins also.
And you can hear more of that conversation on the Bloomberg Tape podcast. You can download it wherever you get your podcasts. Also out with earnings last night was Apple. That stock today down 4.8%. An Icon Enterprises shares plunged today. Icon was down today by just about 23.2%. Those are our top company stories at this hour. I'm Charlie Pellet, and this is Bloomberg.
This is Bloomberg Business Week with Carol Messer and Tim Stenevec on Bloomberg Radio.
It is Bloomberg Business Week on this Friday afternoon. Tim Stenevec joined by Madison Mills for the week as Carol gets some well-deserved time off. Somebody who's not getting time off this afternoon is Nancy Lyons. She's in our 99.1 newsroom in Washington, D.C. for World and National News. Hey, Nance.
Thanks, Tim. A day after being arraigned on charges of trying to overturn results from the 2020 presidential election, Donald Trump is calling for the Supreme Court to step in. He writes on Truth Social that his opponent has hit him with a barrage of weak lawsuits, which require massive amounts of his money. The latest polling in the GOP race, though, is pointing to a vulnerability for former President Trump in the 2024 race.
The New York Times Siena College survey of caucus goers in Iowa shows Trump with 44% support, 24 points more than Ron DeSantis in the early caucus state, but it's less than the 37-point lead for the former president in nationwide polls. The survey suggests the Florida governor's efforts in Iowa may be having an impact. This poll was taken before Trump entered his not guilty plea in Washington yesterday. Nathan Hager, Bloomberg Radio.
Russian President Vladimir Putin's key rival, Alexei Navalny, is facing another 19 years in prison. A Russian court today convicted the opposition leader on extremism charges. Navalny is already serving a 9-year prison term on a variety of charges that he says were politically motivated. 9 members of Congress, 6 Democrats and 3 Republicans, toured the blood-stained and bullet-pocked halls at Marjorie Stoneman Douglas High School in Parkland, Florida today. Florida Republican Congressman Mario Diaz-Balart, who helped organize the tour, says gun reforms are necessary.
I'm hoping this is, again, another way to reinvigorate those conversations. And it's not just the conversations for conversation's sake, but to actually get results from Washington.
Diaz-Balart says going through the building was like going through a time capsule of that horrific moment. Few people have entered the building since the 2018 mass shooting that killed 14 students and 3 staff members. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Nancy Lyons. Now back to you, Tim and Madison.
Thank you so much for that update, Nancy Lyons. Really do appreciate it. Well, just now, Maddie, drawing my attention to one of the most read stories in Bloomberg Business Week. It's all about Gary Gensler, the head of the SEC. He's focused when it comes to the risk to markets and investors. And no, we're not talking crypto. It's about when artificial intelligence is actually making trades and recommendations.
Okay, you know what's like my only thing with this,
Tell
Tim?
me.
This is exactly how, and the reason I was delayed just now is because I was looking up media coverage about the internet from the 90s. Like we do this.
We're going back in
We
time.
do this every time where we're like, this is going to be crazy and we're going to have to reinvent our entire economy and it's going to take away all of our jobs. And every single time we somehow find a way to keep chugging along. At least you and I do. So I would encourage Gary Gensler, who should definitely be taking advice from me, to look at our past to learn what we might be looking forward to in the future with the AI play here.
Well, our own Austin Weinstein writing in Bloomberg Business Week that unlike digital coins and non-fungible tokens, those are NFTs, AI warrants the hype, according to Wall Street's top regulator. Here's what Gary Gensler said recently. This is the most transformative technology of this generation. Quote, there's a there. We can get to crypto later. We're taking so much of what we humans do on a daily basis and automating it. So Austin writing that mass automation can have cascading implications for trillions of dollars in assets that trade on markets overseen by the SEC, investment advice, recommendations generated by AI, nudges, those all have the ability to fundamentally change finance. Yes, they can help firms better serve their clients, Maddie, that's what we've talked about in the past. But left unchecked, AI can be used to obscure who's at fault